Good morning and welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. And joining me live at MarketSite today is Mannik Dhillon. He's the president of VictoryShares, as well as Mark Van Meter. He's the head of capital markets and trading. Gentlemen, thank you very much for joining me at Nasdaq MarketSite this morning. Let's talk a little bit about the product first. Give us some insight into VictoryShares.
Well, thank you for having us today.
Welcome.
VictoryShares is Victory Capital's rules-based product platform. What we seek to do is provide clients with outcome-based products and solutions, mostly through the exchange-traded wrapper. So as of the end of last quarter, we had nearly $2 billion under assets under management across a variety of options. And what we really try to do is offer them a suite of volatility-weighted strategies, income strategies, risk-mitigating strategies. And with the adoption that we've seen from the advisors, we really think that they've started to understand how these types of products can bridge the gap between the active and passive portions of their portfolio.
All right, and Mark, my question to you is, with so many ETF products out there, let's discuss some best practices and strategies for the RIA.
Sure. As you mentioned, lots of ETF products and more coming to market every day. Quite a few of these have low average daily volume. So it's common for advisors when they're looking at new products to assume this is illiquid, I can't trade it has low volume. But I think this is where trading ETFs and stocks are different. In an ETF, it's all about the underlying basket liquidity. So if it's a liquid basket of stocks, it's easy to create new shares of the ETF, where you don't have that capability in a stock that has low volume. So you really need to think about them differently. And we really stress to our advisors that they understand the products that they're getting into and the type of basket that is underlying the ETF.
Right. What about liquidity, though? Do you get any questions in terms of liquidity? How should I trade these if it is lower volume? How do you manage the different types of orders and so forth?
We absolutely do, and there's three main points that I want to stress. For large orders, it's important to get those orders to a trading desk. Second, for the small orders that are likely to be routed to exchanges, understand the order types, market versus limit. And the third point is, for the early part of the day, to be extra careful. So back to the first point with large orders, especially in ETFs that have low average daily volume, market makers are the primary source of liquidity. So you want to go direct to the source of liquidity, the market makers. And the best way to do that is by using a trading desk. So all the large advisor platforms have trading desks that have direct connectivity to those market makers. Now, market makers will also post liquidity on exchanges, but generally in smaller size. So if an advisor has a large trade they want to do and they're routing it to venues that generally have smaller orders, that's not very efficient.
Right.
So what they want to do is get that order to the trading desk that has the access, and in many cases can get multiple market makers competing with competing quotes to get the client the best price. There are a lot of examples when you want to route small orders to the exchanges, and that can be a very efficient way of doing it. Market orders and limit orders are the two most common order types. Market orders are generally the default order type for many systems. You're going to get filled. It's usually going to go pretty fast, but ultimately you can suffer on price if not careful. So with limit orders, it's a way to limit your risk, to say there's a price that I won't pay above. One of the downsides there is the quotes move quite a bit. So advisors want to be very thoughtful about when placing orders, think about the size, and it varies by ETF.
Right, and also time as well, too, because you don't want to, the first 30 minutes of the open and also the close, you're going to see more wild swings in pricing as well.
Yeah, absolutely. And the third point is about the early part of the day. So specifically the opening auction. That's a very challenging time to trade an ETF. Now the issue is ETFs and stocks open at the same time. So the ETF derives its price from the prices of the underlying basket. When those are in auction, you have yet to be determined prices. It's very difficult to price ETF. So as a result, there's very low liquidity that's there on the opening auction. So we would advise clients to avoid trading on the opening auction, or if they have to use a limit to protect themselves. It's also important to realize that in the early part of the day, ETF spreads are generally wider than later in the day. The reason is, as I mentioned before, ETF liquidity is a function of the underlying basket liquidity. Well, stock spreads are wide. So you have the open, you have price discovery that's happening right at the open, lots of news being incorporated into the market, lots of new orders entering the market. Spreads are wider. Right. So that's going to reflect in the ETF spreads. So recommend if there's no urgency to a trade, if you wait, on average, you're going to experience lower spreads. And that's a really important thing for advisors to know.
All right, well, thank you very much. But Mannik, let's get back to product and design with all of the ETFs that are out there and with all the different trading parameters that RIAs have to follow. How do you manage that at VictoryShares?
Well, we're very mindful of all these issues that Mark's brought up. For example, the underlying liquidity of the basket, the securities that you put into an index that results in an ETF is very important. So it's not just about saying that it is the best strategy. You also have to think about, is it going to be properly and traded at the end of the day? So what that means is when we sit down and design products, we're looking at geographies. For example, US markets are generally more liquid. Large cap securities are more liquid. They will, when they trade, be easier to transact, have tighter bid-ask spreads, and so forth. Now, the other thing that's important, though, is education. And so we've talked about liquidity for stocks and ETFs are different. We've talked about the importance of small versus large trades and going through the desk and not trading at the open. Now, ETFs have been around for a long time, and we think that everybody knows how they work and how they trade. But with the proliferation of products, we think that education is really important. So we've been spending a lot of time educating clients around how these products are designed and how they should be able to get in and out of them. One of the things that's really important is with the ETF industry having started basically with access and exposure-based beta products where I want in, I want out, and pennies matter.
Right.
Now the products available are much different. So you have these strategic beta offerings that are designed to be long-standing strategic placeholders in portfolios that drive a specific outcome. So while cost of trading and fees matter, they have to be taken into consideration with a number of different things. The strategy is very different than an ETF. ETF's just a vehicle. The strategy is what you're looking at, and all these things have to come together, and that's what we're trying to help with.
All right, and to wrap up, do you think that there's still room in the industry to introduce new products?
Yeah, it's a tough question, right? With
Yeah.
thousands and thousands of products out there. But if you think about where the assets in ETFs lie, still a shadow to what mutual fund industry is. So we definitely think there is room for well-designed, intuitive products. At the end of the day, the only way to generate excess return or mitigate risk is to be different from some benchmark. That's what active management used to be. We think there is room for products that will help clients deviate from a benchmark and do it in a lower cost, tax efficient way. So that will allow for thoughtful products to prevail. Some of the spaghetti at the wall product strategy that's out there, may not be what you see in, 5-10 years from now, because it's just not going to resonate with the advisor.
All right, well, thank you very much for joining us at MarketSite. And traders, as always, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.